Well, let's go across to now Mr. Sandeep Garg. He's the MD at WEL Enterprises, joining us to talk to us about their earnings because on a year-on-year basis, the revenue have remained pretty much flat with a revenue profile of just 700 odd crores, but the profitability has inched up quite high, and that's because the margins have improved substantially to 15% versus 5%. Mr. Garg, I understand that the business is very bunchy and lumpy in terms of the quarterly performance, but nonetheless, in terms of the margins and profitability, is this level going to be sustainable?
Thank you. Good morning. I think margins in this business are determined by a few things because as a conservative and a company which accounts for the costs as soon as they get incurred, we will have some variations in the quarterly EBITDA margins and the PAT margins. However, our guidance for the overall remains unchanged between 10 to 12%. This quarter, it has been we have been able to recover certain past costs that we had incurred, and hence the margin seems to be a bit better than what we are guided by. I am overall very excited about the company and the industry because we have a very healthy order book, a very healthy cash and a balance sheet strength. And the push of infrastructure by the government is great, and we are in the two very promising sectors that are water and road. So overall, I think it's just not a one single quarter issue, but on an annual basis, we are very confident of growth, both in terms of revenue and in terms of our EBITDA margins.
What's growth coming from? Is it water? Is it BOT? Is it road?
So I think we would target for kind of a 50-50 scenario for our growth coming from water and road. We believe that we need to make these two verticals the pillars of the company. So that's something which we believe that will help us be a balanced company. We expect the water to be primarily EPC. We are also expecting substantially EPC contracts in the road, but we will be also looking at HAM, where we believe the margins have slightly improved.
That's a take coming in with respect to various verticals. But if I have it right, your order book is close to 10,000 crore rupees. In terms of the execution, do you expect some sort of improvement in the pace? Because right now it's still around that 700-800 crores on a quarterly basis. Can it reach 1,000 crores so that the run rate for the full year becomes 4,000 crore?
So our internal target is somewhere around 3,600 crores for the FY24. The weathers and the local issues notwithstanding, not challenging us too much. We expect that we will be somewhere around that level for the FY24 in the revenue terms. And as I said, the EBITDA margins are going to be remaining robust, anything between 10 to 12%. That's what our internal targets are.
There is this phase for every construction company where legacy orders, they bring the aggregate picture down. There's a phase where legacy orders, they become less and new orders come at a higher rate. What is that picture like for you? Are you still haunted with the legacy orders, or it's now more towards new orders?
So I think our legacy orders are pretty profitable, and they have been some lag in the start of some of the projects, but primarily all our order book is very healthy in terms of the margins. I think we are in a very good position to understand where we have very good healthy order book which is very profitable, and we are also targeting very big order book growth going forward. We expect that this year we will be able to book anything between 6,000 to 8,000 crores, so which is a much faster, bigger order book than the run rate that we are targeting. So we expect that FY25 will start with a very healthy order book, as well as FY24 will close with a very healthy revenue growth as well as EBITDA growth. So that's what I would have a take on my company.
Lastly, before I let you go, can you give us a timeline on the monetization of both the HAM and the BOT toll assets and the receivables that you're expecting?
So in terms of the Actis deal, one of the BOT toll projects that we have sold 49%, that 51% is supposed to be transferred as soon as the approvals from NHAI come in post the COD. So we expect anything to happen either in the Q4 of FY24, or it may also spill over to the H1 of FY25. Primarily, we have received already 90% plus money on that account, so we're expecting anything around 100 and 150 crores in that range from actives once that transaction closes. In terms of our two HAM order books, one of the project is about 50% complete. The second is about 20% complete. We believe that it will take about 18 months from now to complete these projects, and some period for attending to the startup issues of the project. So we expect in another 2 years we will be in the market to be able to sell. We have a loose MOU with Actis to consider those projects under similar terms. However, we will be very actively looking for any suitors that would want to buy these assets. Just to remind you, these two assets put together are somewhere around 3,500 crores at a portfolio level. Assets that we expect to complete and divest in next 2 years or so.
500 crores, that's the number. Thank you so much for clearly laying out the plan in terms of what the next 2 years are likely to be in terms of divestment. Mr. Garg, we let you go on that note. Thank you so much for joining us. The stock is holding up with a gain of around 5% today, and it has a decent run up this year already. We have seen a move of almost 60% in Welspun Enterprises on a YTD basis, and they have now the internal target of 3,600 crore on the top line for this year with a margin profile of around 10 to 12%. Quickly, in terms of the stock-specific action, it is IRFCL or Indian Railway Finance Corporation, which is up around 9%. Pune